Most Indian founders think their financial model is a spreadsheet. It's not. It's a lie detector test. VCs use your financial model to find where your strategy breaks, often before your pitch even ends. At CFO Surge, we see strong Indian SMEs rejected by investors, not because the business is weak, but because the financial model isn't believable. This is not an Excel tutorial. This is a strategy deep dive. If your model is just a best-case story built on hope, you're not showing ambition. You're quietly killing your valuation. Today, we go beyond Excel to the strategic mistakes costing Indian SME founders crores in funding. The biggest mistake we see is treating financial modeling like accounting. Accounting explains the past, while modeling plans the future. Confusing the two is where your credibility starts leaking. Many founders hand projections to their chartered accountant. CAs are excellent at compliance, but they're trained to look backward. Investors want driver-based models, not conservative summaries. Let's talk about why drivers matter and what investors really want to see. If you say you'll hit 50 crore rupees, investors don't care about the number. They ask how. They want to know the operational drivers like sales reps, conversion rates, and customer acquisition cost. If spending 1 rupee doesn't clearly create 5, your model is just a wish list. Models must clearly show the mechanism of value creation. Next, let's address one of the most common mistakes: growth illusions. Mistake 2 is the infamous hockey stick. If revenue triples but headcount and costs don't move, your model has failed the lie detector test. Real growth comes with necessary friction. VCs and PE funds look for operational leverage. They expect hiring waves, margin pressure, and working capital strain before improvement. Pain in the model signals maturity. Now let's talk about the silent killer for many Indian SMEs: cash flow and working capital. For Indian SMEs, the silent killer is working capital. 90 to 120-day payment cycles are common. Ignoring this is how profitable companies run out of cash. Many models show profit and forget cash. You can be profitable on paper and still die because cash is stuck in receivables or inventory. Investors check this immediately. To gain investor trust, your model needs to reflect the harsh realities of your business, not optimistic assumptions. If your model assumes customers pay on day 1, credibility is gone before Q&A. Investors want to see the real cash gap and how you plan to survive it. Strong models use scenarios: a base case, a downside case if growth slows, and an upside case if a big deal lands. This shows preparedness, not pessimism. It proves you understand the risks. A real model isn't static. It's a living document, reviewed monthly to test assumptions and guide your hiring, marketing, and capital decisions. That's how CFOs use models. Funded companies aren't just better ideas. They have clearer financial strategy. Investors don't buy products. They buy capital discipline. If your financial model feels unclear or works against you, we can help. Book a strategy session with CFO Surge using the link below. Like, subscribe, and let's build businesses that last.